Welcome to Earnings Recap. Today we're covering Costco Wholesale Corporation's earnings report and call.
That's right.
And listen, before we even get into the financials, there was this one non-financial thing that really stood out.
Oh, yeah. What was that?
Costco has hit 905 locations worldwide as of May 11th. That's a big number.
905. Wow. Yeah, breaking 900 globally, that definitely shows their expansion isn't slowing down, doesn't it?
It really does. And, our goal here in this deep dive is to take that fiscal third quarter 2025 earnings report, which covers the 12 weeks ending May 11th, and sort of translate it.
Right. Put it into plain English for you listening.
Exactly. Help you understand what these numbers really mean, what they tell us about Costco right now, and maybe, where things might be heading.
Yeah, think of it like a snapshot of the company's health this quarter compared to, the same time last year. So where should we start? Maybe the top line, net sales.
Okay, sounds good. Let's unpack this. For Q3, they reported net sales of $61.96 billion. How's that looking?
Well, it's a pretty solid increase, actually. It's up from $57.39 billion last year, same quarter.
Okay, so about, what's that, an 8.0% jump?
Yeah, 8.0% just for the quarter. And if you look year to date, so the first 36 weeks of their fiscal year, it's a similar story. $185.48 billion this year versus $171.44 billion last year. That's up 8.2%.
So pretty consistent growth across the board then, not just a one-off good quarter.
Exactly. The sales momentum seems pretty steady.
That's definitely positive. But, with a retailer like Costco, those comparable sales figures are often even more revealing, right? Because they look at existing stores.
Absolutely. They strip out the impact of just opening new warehouses. And this is where it gets pretty interesting, actually. So the reported comparable sales total company were up 5.7%. Which is, okay.
Right.
But they also give us these adjusted figures. And what that does is it takes out the noise from things like big swings in gas prices and foreign exchange rates, things they can't really control.
Okay. So what do the adjusted comps look like?
Much stronger. Total company adjusted comparable sales were up 8.0%.
8% adjusted globally. Wow. Okay. That feels quite robust, especially now. What's that tell us?
It tells us the core business is humming along nicely. Even without new stores, people are spending more at the existing ones, that value proposition they offer. It's clearly still working very well.
Makes sense.
Yeah.
And how did that break down by region, looking at the adjusted numbers?
Right. So the U.S. reported 6.6%, but adjusted it was 7.9%.
Okay, almost 8%.
Yeah. Canada was 2.9% reported, but adjusted 7.8%.
Another strong one.
And then other international reported 3.2%, but adjusted up to 8.5%.
Huh. So they're all clustered in that high sevens, mid-eights range once you adjust?
Yeah.
It looks like foreign currency rates really dragged down the reported international numbers then.
They definitely did. A stronger dollar makes those international sales look smaller when they convert them back. Without that headwind, international looks even more impressive.
Gotcha. And this strength wasn't just in physical stores, right? What about online? E-commerce?
Right, e-commerce. Reported growth was 14.8%.
Which is already good.
Yeah, but adjusted. Even better, 15.7%.
15.7. Okay, so they're clearly getting traction online. That's a big driver.
No question. It's a key part of their growth story now, not just an add-on.
All right, so strong sales, especially looking at the underlying adjusted figures. Let's shift gears from revenue to profit, net income.
Yep. Net income for Q3 came in at $1.90 billion. That works out to 4.28 cents per diluted share.
And how does that stack up against last year's Q3?
Last year it was $1.68 billion, or 3.78 per share.
So, doing some quick math, that's about a 13% increase in profit.
Yeah.
Roughly.
Yeah, just over 13%. A 13.1% increase in net income year over year. That's significant growth on the bottom line.
That really is. So sales up 8%, profit up over 13%. They're growing profits faster than sales.
That's the key takeaway. And it's not just Q3. Year to date, net income is also way up. $5.49 billion this year versus $5.01 billion last year. So, yeah, strong profit trend for the whole fiscal year so far.
Okay, so what's fueling that impressive profit growth, especially getting over 13% in the quarter? What drivers jump out from the report data?
Well, one of the classic Costco answers is always membership fees.
Ah, right. The recurring revenue stream.
Exactly. For Q3, membership fee income was $1.240 billion.
And that was up from what, about $1.12 billion last year?
Yep, $1.123 billion last year. So that's about a 10.4% increase in fee income.
Over 10% growth there. Why is that so crucial?
Because, it's almost pure profit, right? It's very high margin. It's predictable. It recurs every year for most members. Seeing that grow over 10% tells you two things. They're adding members and they're keeping the ones they have. High retention. It just provides this incredibly stable base for their earnings.
Yeah, that membership model seems like the bedrock here.
Yeah.
Okay, what about operating income? That gives us a sense of how efficiently they're running the core business, managing costs and all that.
Right. Operating income for Q3 hit $2.530 billion.
And last year?
Last year, it was $2.197 billion. So that's an increase of about 15.1%.
15%. Okay, so operating income grew even faster than net income and sales. What does that signal?
It signals really strong cost control and operational efficiency. They're not just selling more stuff. They're managing the costs associated with selling that stuff really effectively this year compared to last. That operational leverage is a big reason why the net income jump was so impressive.
Got it. Efficiency and those membership fees really boosting the profits.
Yeah.
And circling back to where we started, that expansion, 905 warehouses now.
Yep. 905 globally as of May 11th. And the breakdown is interesting. 624 in the U.S. and Puerto Rico, 109 up in Canada, 41 in Mexico, and then spread across other international spots.
Plus the e-commerce sites.
Right, e-commerce sites serving 8 countries now.
So this physical and digital build-out, it's clearly a core strategy. And we saw the proof in those e-commerce numbers, right? The nearly 16% adjusted growth.
Absolutely. They complement each other. The online growth helps leverage the whole system. Now, beyond the income statement, the balance sheet and cash flow numbers also tell a story about their financial health.
Yeah, one thing that really jumped out at me was the cash balance. Cash and cash equivalents. It went from, under $10 billion at the end of last fiscal year?
$9.906 billion back in September 24.
Right, to $13.836 billion by May 11th this year. That's a huge jump in cash on hand.
It really is. And it shows you how much cash they're generating. Look at net cash provided by operating activities year to date. It's $9.468 billion.
Wow.
Up from $8.381 billion last year. I mean, the core business just throws off a ton of cash.
And they are putting some of it back to work. Investing activities use more cash year to date, right? $3.343 billion used versus $2.706 billion last year.
Yeah, that likely reflects spending on, property and equipment, building those new warehouses we talked about, maybe upgrading technology, logistics, that sort of thing. It's investment in future growth.
Okay, but that doesn't fully explain the huge cash buildup. The really dramatic change seems to be in financing activities. Cash used in financing was way down. $2.182 billion used this year versus nearly $9 billion used last year. What happened there?
Ah, right. That's the key piece. Remember last fiscal year they paid out that massive special dividend?
Oh, right. That was a huge cash outflow.
Exactly. That didn't happen this year, at least none these first 36 weeks. So you combine the really strong cash generation from operations with the absence of that giant dividend payment, and boom, the cash balance swells up.
Okay, that makes perfect sense now. Generating loads of cash, investing a good chunk, but not having that big one-time payout leaves them sitting on a much bigger pile of cash. Interesting, too, that their inventory levels stayed pretty flat.
Yeah, merchandise inventories were just over $18.6 billion, very similar to the end of last year. With sales growing like they are, holding inventory steady suggests they're managing it pretty efficiently, turning it over well.
All right, so let's try and boil this down. Key strengths and maybe any weaknesses we can see just from this Q3 data dump.
Okay, strengths, definitely the strong underlying sales growth, especially adjusted.
Right.
Robust profit growth, net income, operating income, both growing faster than sales. That's huge.
Driven by what?
Driven significantly by that solid, growing, high-margin membership fee income, plus the continued expansion, both physical stores and e-commerce. And, as we just discussed, really strong cash generation from the business, leading to that beefed-up cash balance, which gives them a lot of flexibility.
Okay. Any weaknesses apparent in these numbers? Any challenges highlighted?
Well, strictly looking at the report, the main sort of negative factor was the foreign exchange impact.
Right, hitting those reported international sales.
Exactly. The underlying business there looks strong based on adjusted numbers, but the currency swings made the reported growth look weaker. It's a headwind, not necessarily a fundamental weakness in operations. Also, interest income was lower, but like we said, that's mostly tied to prior year financial stuff, not really a core business issue.
Gotcha. So, pulling it all together then, what does this quarter suggest about where Costco's heading? What's the future impact look like based on this?
Well, it's interesting how the pieces fit together. That strong membership growth and presumably high retention it just validates the whole model. It means a stable, loyal customer base providing that predictable high margin revenue stream. That's foundational.
And the investments we saw cash going into new warehouses, into e-commerce, that clearly signals they're building for more growth,
Right.
reaching more people, more markets.
Exactly. And you combine that planned growth with that much larger cash balance we talked about. Well, that gives them serious firepower.
Firepower for what? More aggressive expansion, acquisitions, maybe another special dividend down the road.
Could be any of those. It gives them options. They're in a really strong strategic and financial position coming out of this quarter.
Yeah, this report really paints a picture of a company that's kind of firing on all cylinders right now. Sales are growing, they're operating efficiently, and that core membership model is as strong as ever.
I think that's fair. The results really underline how well Costco's value proposition, quality goods at low prices in that warehouse environment continues to resonate with shoppers, keeping them loyal and paying those fees.
It definitely makes you, the listener, think, right, if you're a member, what does this continued success mean for you? Does that strong financial position translate into even better prices, more convenient locations opening up, better online experience, or maybe another one of those special dividend checks eventually?
Certainly gives management choices for how to deploy that success.
Well, that wraps up our deep dive into Costco's Q3 2025 earnings. A lot to unpack there, but a pretty positive picture overall. Thanks for joining us.